Hello, this is Corey with Freedom Investment Group, and today I'm going to talk to you about an exciting topic, IRR and AAR and cash-on-cash return. Oh my! I'm going to go into an example to help you kind of get a better conceptual understanding of what these returns mean, because it's not totally intuitive, and they're pretty good. There are three different metrics that are used a lot, and you can compare one investment to another with them, but you have to be really careful which one you're looking at, because they can have vastly different numbers for the same investment. And so if you're comparing one type of return in one to a different kind of return in another, they can mean totally different things. So I'm going to try and go in to an example and make these a little easier to understand. So let's dive over to my whiteboard. I've got a little bit of gobbledygook there. All right, so IRR stands for internal rate of return, and AAR stands for average annual return, and cash on cash return is the other one that we'll look at. There's a bunch of others, but those are three that are commonly used. So for this example, I am going to use a hypothetical investment. And I'm going to say years 0, 1, 2, and 3. And so let's just say that for example 1, we are going to invest $100,000. I'm going to put a negative 100 at the beginning here at 0. So negative $100,000. Your bank account goes down by 100 because you invested it in this investment. And let's say that in year 1, you get paid out distributions of $10,000. And in year 2, you get paid distributions of $10,000. And in year 3, you get your money back plus another $10,000. So you get $110,000. And now your investment is done. In this scenario, your cash on cash return out of the gate is going to be 10 divided by 100. I'm going to actually use a different color here. Your cash on cash return is going to be 10 divided by 100. So cash on cash, I do this here. Cash on cash is going to be 10%. And that's just your first year's. And you could do a different cash on cash for each year, but your first year's cash on cash is going to be 10 divided by your 100. So that's 10%. Your average annual return, well, to do this, you discount getting your capital back, and you just figure out how much total return you got divided by the number of years. So in this case, you got $30,000, 10, 10, and 10, and you got your capital back. So you got $30,000. And if you take 30,000 divided by 3 years, that's 10,000 per year. And you divide that by your investment, which is $100,000. Your average annual return is also 10%. And so those are both pretty easy to calculate. IRR is a trickier equation, and what I'm about to say you don't need to know, but IRR takes into account, and I'll explain it in more layman's terms, and I think these examples will help you so you don't need all these fancy words. But the IRR is your internal rate of return. It takes into account the time value of money, and it uses net present value and the discount rate to determine that. You don't need to know any of that to understand what this is. What I want to communicate is IRR, and you won't see it from this example, but IRR takes into account compounding, the compounding of your investment. So AAR is just your total amount you got divided by the total number of years. IRR takes into account when that money showed up. So if the money didn't show up every single year, if you got less, then it effectively treats it like you're reinvesting those returns, and you get your interest on your interest. And I think an example will help to show that. So in this case, you got $10,000 every year. So if you were to punch this into an IRR calculator, which I did just before I started the video, you would also get an IRR of 10%. Whoop-de-doo, Corey. 10% across the board. What does that mean? Well, let's look at another example, because I think this is where it's going to start to make some more sense. Example 2. You have your same $100,000 investment, but in this case, you're going to get paid your whole return at the end. There's no cash flow in the beginning, and they're either increasing the value and selling it, or maybe they're just holding up the cash flow and giving it out all at the end. For whatever reason, you're getting no distribution, and then at the end, you get $130,000. So in this case, you're getting the same total return, 30,000 on your 100,000 over the same time span of a 3-year span. But let's see what this does to your returns. Your cash on cash, at least year one, let me make this over here because you technically can calculate this on any year. Your year one cash on cash is 0 divided by 100. So that is actually 0% cash on cash. Doesn't mean it's a bad investment. It just means you're not getting return through distributions. Your average annual return, well, how much was our total? It was still $30,000. We still got that return over 3 years. So your average annual return is still 10%. 30,000 divided by 3 years gets you 10,000 divided by 100 gets you 10%. Your IRR. Your IRR, like the AAR, takes into account your return, all the different returns over the life of the investment, but it takes into account that time value of money. So if you were to punch this in there, you would not get 10%. You would actually get about 9.1% in this case. 9.1%. And don't worry about the specific number here. What you need to see is that the IRR is usually going to be less than the AAR. Not necessarily true. If we had gotten 30,000 here and then they held on to the 100 till the end, and then you got your 100 back, the IRR would actually be higher, I think. But so usually when you get that big, when it's like you get some kind of payments or not along the way, and then the big payout at the end, your IRR tends to be less than the AR, and it can actually oftentimes be significantly less. So in this case, you've got this 9%. And so basically what this is saying is the AAR is saying if you take your $100,000 and paid yourself a 10% return on that every year, you'd end up with $30,000 of return. So that's 10% every year on your $100,000. But notice the AAR does not account for the fact that your 10% in year one and your extra 10% in year two, if you were to reinvest those, which you've effectively done because you're not taking them, if you were to take this 10 and reinvest it, it's not, your AAR is not giving you interest on the interest. It's not giving you interest on your interest. So that's where they're different. The AAR is just assuming you're getting a return on your initial investment, and any of that return, even if it's not paid out along the way, it's assuming a 10% annual return, but that 10% return, that 10% interest does not apply to the interest, if that makes sense. Whereas the IRR does apply that. So if you were to take a 9.1% return, that would be the same as scenario one, except instead of getting paid out, you're going to reinvest it. So let's say that you've got and it's technically 9.1393, whatever. We'll just call it 9.1. If you had a 9.1% return, year one, you would get $9,100. You would get $9,100 or $9,100, but you would reinvest that. So now you've got 109.1. And then you would get 100, and then you would get 9.1% of that year two, whatever that is, and then you would reinvest that. So maybe now you've got 118.8, or I don't know, I'm doing the math in my head there, but 118 point something. And then you take that reinvested again. If you take 9.1% of that year three, and then cash everything out, you would end up with $130,000. So it's basically the rate of return you'd be getting if you're reinvesting your proceeds, if that makes sense. So it's just it's effectively saying every year, whatever portion of your return you're not taking, you are reinvesting at that same rate. That's what it's saying. It's compound interest. Einstein's eighth wonder of the world. That's what it is. It's accounting for your interest on your interest, or compound interest. That's the difference. And so then if we do one more here, I'm going to just do one more just to kind of illustrate how these can vary drastically. So I'm going to do this. Let's say in example 3, we invest $100,000. We get $10,000 of distributions. And then we also get the $10,000 in year 3, but we also managed to make the asset go up in value. So it also, let's say that the asset goes up in value from 100,000 to 140, and we get our $10,000 distribution. So we end up with $150,000 at the end. This is maybe a little more typical to how an investment, a real estate investment might look. Maybe it's sometimes usually longer than 3 years, but where you get some cash flows along the way, and then you have a big refinance or sale at the end. And let's say that this is after, if this is a real estate, let's say this is after all closing costs and broker's fees and whatever else you're going to pay, this is what you end up with. So cash on cash return here is 10. So your initial cash on cash, year 1 cash on cash is once again 10%, because you got this 10 divided by this 100. Your average annual return, now you've got 10 plus 10 is 20 plus 5 plus 50 is 70. So you've got 70 divided by 3, which is 23.3%. So your average annual return is 70 divided by 3. So that's 23.3%. And the IRR here is 20.9%. 20.9%. So this is what an investment might look like if it hit that mythical 20% IRR. And oftentimes when I'm running a number where it's further out, 7 or 10 years out, sometimes you'll see AAR up in like the high 30s, 38, 39, 40%, and the IRR might be 17 or 18%. So these can actually vary drastically. Basically, the more number of years that it's taking to get that big payout, the more these are the bigger the difference is going to be with these. So I hope that makes sense. The cash on cash is just any given year. Oftentimes people look at it year 1, but it's any given year. Any given year, it's the distribution divided by how much money you put in. The AAR is the total amount divided by the years. So it's basically saying if you're just getting interest on your capital and you're not getting interest on your interest, what your return would have been on that capital. And your IRR is saying if you were going to get a return on your capital plus any undistributed interest, then it's going to give you interest on the interest. And so then saying what rate of return would that be? And so obviously if you're getting interest on your interest, then you need a lower interest rate to hit the same final payout. So that's kind of what those are. So it's important to notice you wouldn't want to look at an investment. Say you looked at this investment, and let's just say you keyed in on this 10% number right here, and you said, that's my return. I'm getting a return of 10%. And then you looked at another investment, and someone else is telling you, hey, I've got an investment with an average annual return of 15%. And you might be thinking, why would I do this 10% thing when I can get an average annual return of 15%? I can get a return of 15% on this other one. You need to be careful of what return you're looking at, because in this case, your average annual return is actually 23. So if the other one's saying average annual return of 15, you can't compare that to cash flow. You have to compare it to average annual return. And same thing with IRR. You have to make sure you're apples to apples, and you want to think which of these returns is more important. If you are retiring now and you're going to need to live off of this income, you might not care so much about these AAR and IRR. These are kind of they're not hypothetical, they're real, but they're down the road. You don't see that payout sometimes for many years. Whereas the cash on cash is real right now. So if you're retiring and you need this money right now, you probably care more about cash on cash. And if it got a lower IRR but a higher cash on cash, that might be the right investment for you. If you're not retiring now, you have a job, you're fine, and you're trying to build wealth so that you can retire in 5 or 10 years or pass on wealth to your kids, or for whatever reason, you don't need the cash flow right now. Maybe you just have so much cash flow, you have more than you need, then you shouldn't care as much about cash flow. Then your IRR and your AAR are going to be the more important ones, because that's showing you what your overall payout is going to be, what your overall return is actually going to be down the road. So if you had one that was a higher cash on cash, but a pretty low IRR, maybe like this first example, then versus the third, like this one would be much less good if you were trying to build wealth, that example 1, right? Whereas the third one would be great, right? So you just want to look at like what is it what are you looking for? Are you looking for cash flow now? Do you need to live off this cash flow now? If not, you should really be keyed in on the AAR and in particular this IIR. It's really the most accurate representation of your overall return. It's going to account for your cash flow, loan pay down. It's going to account for any appreciation, all of that stuff. So I hope that helps. And yeah, I'm going to stop the screen share here, and I hope you have a wonderful day. Cheers.